Round of new tariffs from President Trump.
As of this morning, he's imposed new tariffs on steel and aluminum as his global trade war intensifies. ABC's Nicole D'Antonio has the details.
This morning, President Trump imposed sweeping new 25% tariffs on all steel and aluminum imported into the U.S.
Donald Trump has once again sent shockwaves through the global economy by imposing a 25% tariff on steel, aluminum, and car imports from Europe. This bold move has raised serious concerns, particularly for Sweden, a country whose economy heavily depends on exports. With billions of dollars at stake, the question remains, will Sweden stand with the EU in retaliation or strike its own deal with the US? The Trump administration officially enforced the new tariffs, putting Sweden in a vulnerable position. With exports accounting for 45% of its GDP, the impact could be devastating. Sweden's auto industry is facing significant challenges. Volvo Cars, the country's largest auto manufacturer, exports over 100,000 vehicles annually to the United States. The new tariffs could raise prices by $8,000 to $12,000 per car, making them far less competitive. Scania and SKF, leading producers of trucks and industrial components, could see production costs rise by up to 18% due to surging raw material expenses. Economic consequences could be a major blow to Sweden. The United States is Sweden's third-largest export market, contributing over $17.8 billion in annual trade. Thousands of jobs in the steel, aluminum, and automotive sectors are now at risk. But the larger question looms. Will the European Union allow this economic attack to go unanswered? European Commission President Ursula von der Leyen issued a sharp warning. We will not let Europe become a victim of U.S. protectionist policies.
We take today are strong but proportionate. As the United States are applying tariffs worth $28 billion, we are responding with countermeasures worth 26 billion euros. This matches the economic scope of the tariffs of the United States.
Unlike the broader EU response, Sweden is taking a two-pronged approach. First, they are expanding alternative markets by strengthening ties with China, which is investing billions in Sweden's green tech sector. Second, they are building stronger relationships with the Middle East, where nations like the UAE and Saudi Arabia have expressed interest in Volvo's electric vehicle technology. But Sweden faces a critical decision. A united front could pressure the US to reconsider its tariffs and protect long-term European economic interests. However, the risk is that the US may retaliate harder, causing deeper financial losses. Alternatively, negotiate a separate deal with the US. This approach protects Sweden's direct trade interests and prevents further economic damage while maintaining a crucial partnership with the US. But the risk here is that it could weaken EU trade unity, potentially alienating Sweden from its European allies. A survey from Sweden's Trade Association reveals the division in opinion. 63% prefer to continue exporting to the United States despite tariffs. 30% are seeking new markets in Asia and the Middle East, and 7% support completely cutting trade ties with the United States. If tensions escalate further, Trump's tariffs could expand to pharmaceuticals, tech, and clean energy, all key Swedish industries. On the other hand, if the EU retaliates aggressively, it could cause hundreds of billions in trade losses on both sides. Sweden alone could lose over $3 billion in annual exports if this trade war continues. However, Sweden is not powerless. With a $188 billion economy, it ranks 8th globally in competitiveness. Major corporations like IKEA, Ericsson, and Volvo remain dominant in international markets. Is this a trade dispute or the beginning of an all-out economic war between the US and Europe? Will the US economy collapse under pressure? For the second time in days, Donald Trump has backtracked on a major trade threat, this time involving Mexico and Canada. Initially, Trump threatened a 25% tariff on imports from Mexico, but experts warned that Mexico could cut off oil, energy, and car parts to the US, sending America's economy into chaos within a week. Why is Mexico so crucial in North American trade? The answer lies in the United States' heavy dependence on Mexican industries, particularly oil and automotive manufacturing. Mexico's retaliation, how a trade war could cripple the U.S. economy. Mexico plays a critical role in the North American trade equation, particularly in the oil and automotive industries. The United States relies on Mexico for 8 to 10% of its total crude oil imports, with approximately 1 million barrels per day flowing through pipelines between the two nations. In states like Texas and California, refineries are heavily dependent on Mexican oil. If this supply were disrupted, it could lead to skyrocketing fuel prices and further inflation in the U.S. economy. But that's not all. Mexico is deeply embedded in American car manufacturing. General Motors, Ford, and Chrysler all benefit from Mexico's cheap labor and tax incentives. Millions of auto parts are produced in Mexico and imported into the U.S. every year. A trade halt would result in severe supply chain disruptions and rising production costs for U.S. automakers. The big question remains, if Mexico retaliates, how devastating will the impact be on the United States? But before we dive into the next phase of the video, share your thoughts on President Trump and the tariffs and how you think the countries that were issued the tariff should retaliate. And, don't forget to like, subscribe and comment to our channel for daily updates. Mexico's Plan B retaliation measures against the United States. While Mexican President Andrés Manuel López Obrador has been reluctant to escalate tensions, he has made it clear, "We are ready to act if necessary." What could Mexico do in response? First, tariffs on U.S. agricultural goods, corn, soybeans, and beef exports could face high tariffs, hitting American farmers hard. Second, blacklisting U.S. companies. Mexico could restrict U.S. businesses, making it difficult for them to operate in the country. And third, shifting trade alliances. Mexico is strengthening ties with other global partners, reducing dependence on U.S. imports. These measures could disrupt global markets, especially in the automotive and energy sectors. Diplomatic efforts. Can Mexico and the U.S. avoid a trade war? Mexico's President-elect Claudia Sheinbaum is actively working to ease tensions through diplomatic channels. March 6, 2025. Sheinbaum will have a direct call with President Trump to discuss possible compromises before any retaliation is implemented. Her message is clear. We don't want a trade war, but if tariffs continue, Mexico will not sit back and watch its economy suffer. The stakes are high. Neither country wants to lose the economic benefits they have built over decades. But if the trade war intensifies, both sides stand to lose billions. Who will blink first? China strikes back. The U.S. loses billions in trade and energy markets. February 2025. The Trump administration imposes a 20% tariff on Chinese goods, escalating trade tensions once again. China responds aggressively, cutting U.S. imports and strengthening trade alliances with Canada and the European Union. The result? American farmers and businesses lose access to a multi-billion-dollar market. Canada and Europe step in to replace the U.S. in key trade sectors. Canada replaces the U.S. as China's top oil supplier. For decades, the U.S. was China's primary supplier of crude oil and natural gas. But in March 2025, everything changed. After Washington imposed a 10% tariff on Canadian oil, Ottawa found a new buyer, Beijing. China immediately ramped up oil imports from Canada, thanks to the Trans Mountain Expansion Pipeline, which increased capacity from 300,000 to 890,000 barrels per day. 50% of Canada's crude oil exports now flow to China, reducing China's dependence on U.S. energy. LNG Canada, the new supplier for China's energy needs. It's not just oil. Canada is also stepping up as a major supplier of liquefied natural gas. The LNG Canada project, one of North America's largest LNG export hubs, is set to begin operations in 2025. It will have an export capacity of 14 to 26 million tons per year, directly competing with U.S. energy exports. China is now prioritizing LNG imports from Canada, Qatar, and Australia, further sidelining American suppliers. The shift is clear. Canada is becoming China's strategic energy partner, replacing the U.S. in long-term trade agreements. For American farmers, this trade shift is a devastating loss. While Trump's tariffs are aimed at protecting American industries, they are pushing major global economies, Mexico, China, Canada, and the EU, to seek alternative trade partnerships. Mexico is prepared to retaliate if the United States escalates trade barriers. Canada is seizing the opportunity to replace U.S. energy exports to China. Will the United States adjust its trade policies or continue down a path of economic conflict? Share your thoughts in the comments below and don't forget to like and subscribe now.